Hi, everybody. Welcome to my second home. My name's Andrew Hulsh. I'm a partner here at Mintz. We call ourselves members because, unlike most law firms in the world, we're organized as a limited liability, rather as a corporation, and so we have no partners. But just glad to have all of you here. We hosted this event last year. I think maybe April or May of last year.
It was April. You wait to April.
Yeah, shortly after I actually joined the firm. I'll tell you a little bit about Mintz, a little bit about myself, and then we'll talk briefly about private equity. I can thank Marco for taking up as much time as he did because now I don't have to speak for as long. Thank you, Marco.
No problem. He's my lawyer, by the way.
Yes. Mintz is about a 650 lawyer firm. Now we are based in 7 offices in the United States and 1 office in Toronto, Ontario, which we opened up last year. We are in Boston, which is our headquarters, hence the technology and life sciences focus of the firm. We are also here in New York, obviously, Washington, D.C. We recently opened in Miami, Florida, and we're on the West Coast in San Diego, San Francisco, and Los Angeles. We're I think, very highly regarded in a few areas and in a few industries in particular. Private equity, which is what I do, where we represent some of the largest private equity sponsors in the world. Yeah, I'm not really comfortable naming them just because they don't like to be named, but you can pretty much guess who they are, and we represent them. Mostly in connection with their middle market deals, sub $1 billion deals. We don't really have 40 or 50 people to throw on a deal at any time, so it kind of has to be manageable. So our sweet spot is anything sort of less than $1 billion. And north of 100 million for a PE transaction. And we have about 120 lawyers who focus on private equity. We also have a very substantial venture practice, and I know a lot of you are involved in early stage investing. We have about 40 lawyers who are dedicated exclusively to venture capital here. And they are, they're sort of a few law firms in the world that are really good at venture. There are some of the West Coast firms based in Silicon Valley, and there are about 2 or 3 really high quality law firms in the East Coast that focus on venture. We think we're one of them. But our real value add is in industry areas. So the industry areas that we focus on, and I think we pretty much dominate, are in technology, life sciences, healthcare, and renewable energy and infrastructure. So anything having to do with batteries, like Marco was talking about. We do everything across the value chain, from early stage investing to full buyouts of alternative energy providers and infrastructure. So as I briefly mentioned, I focus on private equity. In addition to doing the transactions, I also form investment vehicles, which is sort of unusual. Most lawyers do one or the other. I kind of got dragged into it by one of my clients about a decade ago, and since then I've formed about 18 or 19 funds of varying sizes. The first one is interestingly was the largest. My first project that I was engaged for was a $3 billion fund, and they've been, they're pretty much of all sizes. But I speak a fair amount about private equity, and I know if you're interested in venture, we can talk about that as well. There have been some pretty significant changes in the market over the past few years, as some of you may realize. When I was speaking publicly in at conferences about private equity 3 years ago, all we were talking about was dry powder and high valuations and how everybody's climbing all over each other to invest. And frankly, the venture ecosystem was the same way. People were just climbing over each other to invest in venture deals. I have one client who we formed a venture fund for that was focused on plant-based foods. He was, of course, based in Venice Beach, California. We formed a fund, and he invested in each of the first 15 companies he looked at. He fell in love with every single company. Not a great strategy.
Not like good recipe for success, right?
You know, he still claims that he's going to be above water, but there was no discipline, and frankly, that was symptomatic of a lot of investors investing during that time, where there was such a frenzy to invest because, you know, everybody thought their venture investments were going to be, you know, the next great thing. Some of them were, some of them weren't. What's happened, unfortunately, for a lot of companies in the earlier stage is that the market's dried up for investment. And so now they're suffocating. They're in fact, I heard a statistic that I won't repeat because I haven't verified it. It's probably inaccurate, but a very, very high percentage of companies that have gone through A rounds and seed rounds and A rounds over the past 3 years are now on the verge of bankruptcy. And so hopefully that's not the case for your investments, and you managed to do better than that.
Andrew, I got a quick question for you.
Yeah, sure, man.
When you see people go into market with like a wrong strategy, like trying to get debt rather than equity or vice versa, do you ever tell them, have you thought about this or you thought about that? Or
Well, look, certainly at this time, this is as good of a time as any for somebody to invest in convertible notes and to avoid a price round, because the markets are so uncertain in terms of valuation. And so, but advising a client to invest in debt now versus equity is a lot different than what it was a few years ago when debt was so cheap. Now with, you know, prime rates as high as they are, you know, it's almost like everything is high yield debt. You know, to invest in a company that has even a modicum of risk, if you're a debt investor, you're going to want at least 12, 13%. You may want a discount on the, you know, an original issue discount on the purchase of the note. You may want equity kickers. So it's, you know, it's a very different market now than it was. But we are certainly, and I have a number of clients. You know, most of my clients are fairly well established, but some of my earlier stage clients are really in trouble right now. They really need capital, and you know, I'm always loath to recommend them, because, you know, if I recommend a company to invest in, then if it doesn't work out, it's on me, and so that's just not my job. And so I tend not to do that, with a couple of exceptions. And but by and large, you know, I try to avoid that. But what has happened in the market is I think you all know, is we've gone from this low interest rate environment where everybody meaning the investor community was sort of so eager to invest, to a situation where what I'm seeing is a lot of people looking at deals with a great more amount of, you know, circumspect, and they're participating in processes, but they're walking away as soon as there's a blemish. And so we're seeing a lot more scrutiny, a lot more dollars, frankly, going into due diligence than we were before. We're seeing a number of companies not necessarily getting the valuations that they want. Sort of the concept of don't do a deal if it's a down round is out the window right now. You know, for earlier stage companies, they just take the capital. And you know, for most of those companies, they're better off doing a convertible note rather than doing a priced round, because they don't have to deal with today's valuations. But valuations are clearly, there's a disconnect right now between investors and companies. I think it's a substantial disconnect, in the sense that the founders of companies are still, you know, smoking the same pipe that they were smoking
amazing.
2 years ago, and sort of saying, well, my company is worth, $30 million when the investor's perception is very different. And a lot of those same investors, have gotten hurt when they did invest in those valuations. So there's got to be a way of bridging the gap. And as I've now said a couple of times, one of the ways is through, sort of hybrid securities like a convertible note, where you don't have to make that decision now on valuations and see how things pan out. And that's good for everybody because a founder of a company doesn't necessarily want to issue equity at a low valuation today. Again,
But are there flaws with a convertible note in a later round? I mean, so a lot of people tried to issue convertible notes as a bridge between an A and a B round. So they weren't able to raise their B rounds, but they already had priced before, right? And a lot of investors, I would say 95% of investors bolted it as a bridge round because they said, hey, this has already been priced. You either take the equity hit and reprice it or not. But we don't want to invest in a note that's going to have some kind of, amorphous valuation. Did you see that or?
not really. I mean, I think there's a great advantage to investing in a note because the note's going to have a valuation cap also. It's going to have a discount on conversion, but it's also going to have a valuation cap. And that valuation cap is normally going to be tied to the last priced round. There's going to be some relationship. It may be lower, but probably not. It's probably that's the baseline is what the valuation was in the prior price round. So I would say no. I think it's a good idea. I think it works.
Even a later round, okay.
Yeah, I do. And look, there are other things you can do also. You can issue warrants. They don't have to be penny warrants. They could be warrants at market price. But I think it's sort of a good strategy. I hate safes, by the way. East Coast lawyer typically hate safes. I hate safes because I think for an investor standpoint, it's great for companies, but from an investor standpoint, it gives you no security. It's just sort of a piece of paper. It's not even a debt. It's just this piece of paper that says you have the right to convert. And if all hell breaks loose, you're sort of nowhere on the capital stack. So I'm not, safes were invented out of laziness, I'm convinced.
Sure.
So, I was at I was a keynote speaker at a conference, the U.S. Global Private Equity Forum, about a month or so ago, downtown in Brookfield Place, and I had a panel of terrific private equity executives from, a number of the largest PE shops in the world, and so, we talked about a number of. I'm going to tell you what some of the questions were and some of the responses because maybe you'll find it interesting. First we talked about sort of the disconnect in valuations. And, I asked about sort of the disconnect between the perceptions of private equity sponsors and venture capital sponsors. And those are the target companies with respect to the valuations. And I mentioned that just a minute ago. And so, the response was, look, let's distinguish between early stage companies, which may not have sufficient capital reserves to fund long-term operations and plan growth. And there are a lot of those companies that are sort of teetering right now. And those companies with positive EBITDA and cash reserves. So the early stage companies don't really have a choice. They have to take money when they can get it, however they get it, or they face, bankruptcy and liquidation. The companies that can hang on, and I'm a biotech investor in public markets, and what I use to distinguish between what I will invest in and what I will not invest in is, does the company have a sufficient balance sheet? Do they have enough cash on their balance sheet to last them a few years? Because that is the death of most biotech companies, life sciences companies. They run out of cash and then they find themselves in a crunch. And they can't raise additional funds, and that's it. Great idea. It may be the next year or so for cancer and one type or another, and they go kaput. So, for the companies that are able to have positive EBITDA, it's better for them probably to slow down and conserve their cash, rather than go full steam ahead. And so, I think that was, one sort of observation in terms of how you approach different companies. You can, as an investor, approach companies, obviously, with a great need for cash in a much more aggressive way than because if you approach companies that are somewhat healthy in an aggressive way, you're either going to pass on you. They'll find somebody that will, give them some sort of debt. Going back to what Marty was saying, the debt markets are fairly active right now, even at the what people call high interest rates today. They're really not that high from a historical standpoint. Those who are as old as me, remember interest rates when they were 17% per annum. Bank rates, literally 17% per annum. And so, which makes me very old. I hadn't gone to law school yet, but I do remember. The next question that I really asked was, what is the impact of higher interest rates on their respective firms? And, different people had different answers. Number one, people are using less leverage than they were before. They may have used 4 turns of leverage, when interest rates were considerably lower. Now they may use two or three turns of leverage. They may use no leverage, and they may have a plan to refinance later. I'm doing a deal right now for a large PE sponsor. They're going with an all-cash bid because it's an auction process, and they're going to do a refinancing in a couple of years. And they're not doing it now. They know interest rates are going to be headed down. They're probably not going up. It's all indications. I'm not much of a prognosticator, but all indications are that interest rates will at some point go down. And so they're planning on refinancing in a couple of years. It also makes their bid a lot more competitive because it's an auction process. They're trying to preempt the bid. We're putting in a preemptive bid in a couple of weeks. It's going to be all cash bid. It's probably not the highest price, but it's close. It's, 400 or 500 million. It's in that range of $400 to $500 million. And hopefully we'll walk away and we'll get it. Obviously, private equity firms and venture capital sponsors have been posting internal rates of return in the 20s and up regularly. I think the expectation now probably needs to be tempered a bit because with high interest rates, your returns are just going to be lower unless you're willing to take that risk and use the same degree or even more leverage. And I think most people are loath to do that because there are all such types of other problems associated with that. One of the big impacts of high interest rates are that many private equity funded deals they're having to divert cash away from, planned growth investments like add-on acquisitions into debt service. So rather than expanding the growth of these companies through external acquisitions, they're using those funds to repay debt, which is a shame, but it is what it is. And they're able to acquire the companies, hold them, and hope for a better day. High interest rates probably, for those of you who are out in the market looking for capital for new funds, new investment vehicles, and I know there are a couple of you out there. The fundraising market, I think, can be divided into sort of 2 camps. The really large funds, it can be venture funds or private equity funds, have still been able to raise substantial amounts of capital. To name a few, that have been published. And I won't tell you which ones we're working on, but EQT, Goldman have both raised billions of dollars recently. Apollo has raised billions of dollars recently. And so at the high end of the spectrum, the sort of bulge bracket, private equity firms have been able to raise a ton of capital. Maybe they're not oversubscribed by 2 or 3 times the way they were 3 years ago, but they're closing their funds. I know EQT closed a $3 billion alternative energy fund just fairly recently. The smaller and let's say 300 million or below, or the emerging managers, the ones that are starting funds for the first time, that is certainly more of a battle. than it used to be. Now, it's never been easy, right? It's never been, putting out your hat and people throwing tens of millions of dollars into the hat. It's probably a little more difficult now. In fact, it's definitely more difficult now than it was. So you have to. So the mediocre ideas and mediocre track records, they're not going to raise money, not for emerging managers. If you're going to raise money as an emerging manager, meaning if you're a first-time fund manager, you are going to have a hell of an idea or a hell of a track record, and you're going to have to be able to prove that to investors.
So I just had a emerging market first-time manager come to me yesterday, and they had a very nice pitch about Latin America and fintech, and then they said, and we're only investing in women-owned companies. I was like, well, what does that do about it? I think feature-rich is not so important, right? It's good deals matter.
Depends what you ask.
It's really hard to get. As soon as you say women-only companies, it's a wholly different group and a smaller group, right? Because it shouldn't matter in the determination of whether you have a good deal or not. For Latin America, I'm saying, if you're in the United States, it's a different paradigm. But if you're in Latin America and you're a first-time manager, emerging manager in an emerging country, not so easy.
Well, I think women are smarter than men, but
I agree with that. My wife tells me that all the time.
and but in any case, what I would say is to your sort of question, Marty. Institutional investors are still very much influenced by that because of political and other issues that require them, and internal mandates that require them to allocate either explicitly or otherwise to women-owned businesses, women-owned funds, or minority-owned businesses or minority-owned funds. We could talk about it all day, whether that's good or bad or indifferent. But the fact is, that is what they're doing. And so when you talk with, and we represent all of the 13 largest pension funds in Canada, every one of them. And I can tell you, every single one of them has a mandate. And all things being equal, as we see, women-owned fund or a male-owned fund or a minority-owned fund, they're going with the other. They're going with the minority-owned fund or the women-owned fund, even if things are not exactly equal, right? Because it's a checklist. They all have.
Yeah. So my checklist was that she's too small for any institution because she's raising a $5 million fund.
Yeah. When you don't have that.
Great when you are institutional level.
Right. But when you don't have that, internal or external political pressure, because think about it, pension money comes from workers. It comes from.
Absolutely.
So there's a great deal of political pressure to do that. And again, maybe that's a great thing in the long run. Maybe that's a world changer. Maybe it makes a lot of sense. I'm not going to say.
I want to agree with your original point, which is that the quality of your deals matters incredible amount, and a lot of the features don't matter that much. Whether you're doing good for the world, et cetera. I mean, especially if you're smaller, if you're an emerging manager, I think quality is everything.
There are statistics, so just like there are statistics for everything in baseball, and literally this person gets a hit every time he wears the blue hat. There are statistics that indicate that investing in businesses that do good for the environment, it provides better returns. I mean, there are actually statistics that support different theories. If you're just doing it based on, performance, sure, I understand that, and a lot of non-institutional investors are going to do that.
I'm saying, yeah,
that makes a ton of sense. I don't know.
Institution, right? So the other part is size matters. Like that, I mean, like these VC firms that have 5 funds that just start at seed and go through Series D. Having that kind of ability to scale up and carry your investments all the way through, that's pretty important. And as you said earlier, they're the ones who are collecting all of the assets. They're the ones who are still raising very successfully the big funds, but it's a really difficult environment for startup funds. If you're not, unless you've got the pedigree and you're coming out of one of those big shops. That's right.
And we represent 2 funds just like that I'm actually involved with. One was started by a former executive at a, let's call it bulge bracket private equity firm. You all will know the name. And the other was started by another senior executive at a bulge bracket private equity firm. And they have incredible track records, incredible histories, and they're going to be raising money. And they're both, both funds are seeking in excess of $1 billion. They're both, interestingly, credit funds, but you're right about that. For earlier stage funds, look, I think it's that much more important to get your ducks in a row, to really show to investors your ability to perform. I think placement agents, at the risk of maybe offending some placement agents here, it's hard. I'm not being as blunt as I'd like probably, but there are only a few placement agents. I mean, ask for their track records, ask what they've done, and have them prove what capital have they actually raised. I don't care who they know. I don't care how long their list of investors is. What I do care about is how much capital have they raised in the last year or the last 2 years, and from whom have they raised it? And that's really all that matters. They can be smooth talkers and they can have long lists and know the world. None of that stuff matters if they haven't raised any capital. So, it's do your due diligence is really what I would suggest. But in any case, long story short, it's a tougher fundraising environment than it was. It was never easy for emerging managers. Now it's.
Do you have any thoughts on crowdfunding and quality of the capital stack?
I don't. I really don't. I don't like it. My own bias, because I don't want any of my clients to be stuck with investors that are not sophisticated and accredited, because it leaves them exposed to claims. I think, and people who participate in Reg A offerings, crowdfunding offerings, or CF offerings, they have expectations that are hard to meet. They expect every investment to be a good investment.
Well, I mean, I think you just said it. A lot of syndicates were put together in the last 10 years that have really fallen apart with the higher level interest rates, because people were like borrowing money to invest, and those syndicates are kablooey.
Yeah.
Whether it's in crowdfunding or in real estate syndicates.
Yeah, I don't really get involved with it. Whenever my clients sort of talk about going to the retail markets for capital, I try to, veer away from that. You can do general solicitations, under, I don't know if you've heard of Rule 506C and 506B. You can, 506C allows you to do a general solicitation, but you've got to verify the accredited nature of your investors. But again, I don't recommend it. The other things we're seeing are sort of, and I sense I'm running out of time because
about 2 more minutes. Yeah.
That's great. We're seeing funds hold on to their investments for a little bit longer than they otherwise would, because this might not be the best time to sell. We are, one question to ask yourself, as to all businesses really, is there a benefit to using artificial intelligence here? How is AI going to intersect with particular business that you're buying? It's impacting everything. I represent a large legal outsourcing firm that does e-discovery. They have about 3,000 employees. And they actually came to us and they asked me if they could pitch to our firm. And I said, sure, of course, you're a client. And they did. And my question to them, which is still unanswered, is how, because they use employees in India and other parts of the world to do e-discovery. How are you integrating artificial intelligence into this whole mechanic? And it's huge, because AI can do what 50 people in a room can do. AI can do in seconds. So that's it has an impact across so many different industries. The other, let me see if there's anything else I want to. I would just say to sum things up. The better buyout funds, the better funds, they're going to have to learn how to work with private credit and integrate sort of credit into their overall cap stack. They're going to have to accept lower leverage. Otherwise, the risks just really get too high. They have to be comfortable that they're paying more for debt, although again, rates have flattened out a little bit. And I think most importantly, they're going to have to, and the better firms do this, they're going to have to know how to operate the assets in the acquired businesses more successfully and to do a better job than the job that was being done before they bought the assets. And that's what always distinguishes the best private equity firms and the best venture firms from the ones that aren't the best, is their ability to take something and either through combining it with operations of another portfolio company, or by replacing management, or just by bringing good ideas to the table or good financing solutions to create, a better solution. And I've seen this very, very, there used to only be a few that really focused on operations once they bought the companies, and now they're all doing it, and they're all doing it with a great amount of zeal. And that's what really distinguishes, the true winners in private equity from everybody else. In any case, I've run out of time, thankfully, and I appreciate you all listening to me.
Thanks so much, Andrew. Great job.